Hello, fellow Rebel Capitals. Hope you're well. So, everybody in the news is talking about how Janet Yellen is going to be dumping or is in the process of dumping, as we speak, trillions of dollars worth of U.S. debt in the form of treasuries onto the market. So, what on earth is going to happen to bank liquidity? All those reserves are going to go into the TGA. Is this going to create more of a banking crisis than we already have? What's going to happen in the stock market? There's a lot of different. What's going to happen to interest rates, for heaven's sakes? If she's dumping trillions of dollars of supply onto the market, well, what happens to the price? You could understand why the price may go down very, very quickly. This is basic economics 101, right? And if the price goes down, yields go up. And if they go up massively, well, what's that going to do to the U.S. economy? What's that going to do to the stock market, for heaven's sakes? And who on earth is going to buy these treasuries, right? We're not talking about $1 trillion over the span of the next year. We're talking about $1 trillion over the next 6 weeks or so. In fact, up to $500 billion just this month. And it's already what, the 15th? So you can see how this can go wrong very, very quickly. Or will it? Let's go over to this article real quick. And let's check this out. We'll do a screen share. And we are at the AmericanBanker.com. Title, Powell, Fed watching Treasury issuance, impact on balance sheet. And so I'm assuming from the American Banker, it's going to be in a little bit more industry lingo than something you'd see on CNBC or Yahoo Finance, but that's okay. As most of you guys know, I speak banker lingo and macro lingo probably as well as anybody. So I'll go ahead and translate for you. Federal Reserve Chair Powell said the Treasury Department's efforts to replenish the government's coffers will likely draw deposits out of the banking system. Okay, great. So what is he talking about? Well, you guys know this from watching my whiteboard videos. The Fed's balance sheet broken down into, we'll call it 3 main compartments, the liability side. Number 1, we've got bank reserves for the commercial banking system. Number 2, we've got the TGA, that's a checking account for Janet Yellen and the Treasury. Number 3, we've got reverse repo. There's a few more components in there, but those are the big 3. So what Powell is saying is that if Janet Yellen issues all these treasuries, then those are going to be purchased by banks, non-bank entities. Doesn't really matter, because what would happen, the net result would be those bank reserves would go from the reserve accounts of the banks and they would go down into the TGA. So if there are fewer bank reserves, then holy cow, we could have a liquidity crisis. We could have another Silicon Valley Bank, First Republic, or maybe we could have multiple Silicon Valley Bank signatures or First Republics. That's kind of the message right here. So what Jerome Powell is saying is that we're going to watch this like a hawk, don't you worry. And like everything else, we've got the tools for that, even though we have to create another tool every single week. Somehow they have all the tools already necessary for any future problem. But let's get back to the article here. Speaking after Wednesday's FOMC meeting, Powell said the Fed will be monitoring markets carefully. Don't you worry about it. As the Treasury, the one entity that has gotten literally everything wrong since pretty much 1990, is on the job. Powell said the Fed will be monitoring markets carefully as the Treasury issues $425 billion of short-term securities this month to ensure the process does not destabilize the banking system. And how would it destabilize the banking system? Exactly what we just talked about. Those reserves going from the reserve accounts of the commercial banks down to the TGA. I find it fascinating that they don't take it one step further and say, okay, so if the bank reserves that are up here, if they go down to the TGA, yeah, that reduces the amount of reserves in the commercial banking system. I wonder what Janet Yellen is going to do with those reserves when she gets them in her account. Boy, she's probably just going to sit there forever and let those reserves collect interest. No, that's not it. Oh, that's right. She's going to spend that money back into the economy, and then the reserves will go from the TGA right back to the commercial banks. Oh, that's why this thing gets so ridiculous. And I get it. Janet Yellen has said that she wants to keep, let's say, $500 billion in there. All right, fine. But let's just say that we do have a hiccup in the market. What's Janet Yellen going to do? She's going to spend that money. She's going to draw down the TGA, or she's going to stop issuing debt to bring reserves into the system. This is a complete nothing burger, like we've been saying on this channel in my whiteboard videos for the last month, for heaven's sakes. But there's more to the nothing burger than what we've discussed. This is a big, complex nothing burger. Powell said the debt issuance, which is aimed at rebuilding the TGA at the Fed, will very likely lead to the reduction of other assets on the central bank's balance sheets. Okay, but let's not forget for a moment, and we just went over this in the last video, that prior to 2008, prior to 2008, there were about 40 billion B reserves in the system. And by the way, that includes vault cash. Most people don't know that. So how much of that is vault cash? Half. So you only had 20 billion or so in quote unquote bank reserves, right? So anyway, how on earth, and by the way, there was 7.5 trillion in M2. And let's not forget how many trillions and trillions and trillions of dollars were outside of the United States. And those dollars should be a call on basically the Fed's balance sheet for those reserves, right? Because those dollars are basically credit. They're loaned into existence. So an IOU would be a call on an actual dollar. And if you want to get technical, the only actual dollar is either currency units or a bank reserve on the Fed's balance sheet. So let's just say you had, let's just give them the benefit of the doubt. Say there's 40 billion in total. Great. We've got 7.5 trillion in M2, and we've got, let's say, 50 trillion going back to 2007 or 2008 in dollars in the global banking system. And somehow, mysteriously, the banking system was fine for years and decades, for that matter. Decades. In fact, if you go back to 1980, how many reserves were in the system then? That would be 40. The exact same amount that was in 2007. No change. But we went from 1.5 trillion in M2 up to 7.5. And what do you think we went globally, for heaven's sakes? And my goodness gracious, the Eurodollar system was cranking out currency units like they were going out of style with the increase in the emerging markets of China, for heaven's sakes. Think about how many dollars that took. But yet reserves didn't change one bit. So now what are the bank reserves? Well, they're up to, 3 trillion? So we've gone from 40 billion to 3 trillion. Yet somehow, by reducing the amount of bank reserves in the system from 3 trillion down to, call it 2.9 trillion or whatever, that somehow this is going to destabilize the system. What are you talking about? Maybe the reserves aren't what's destabilizing the system. Maybe the system's broken. Hello, McFly. Jeez. It's just unbelievable. And these are the smartest people in the room. These are the PhDs, for heaven's sakes. I'm just some guy that almost flunked out of high school. It's quite sad, isn't it? That this is just so obvious for you guys out there. And most of you have probably never taken an econ class, probably never taken a finance class. You probably did a heck of a lot better in school than I did, but you didn't study this stuff. You don't have a PhD in economics. Yet it's so crystal clear. Why? Because you have common sense. That's all that's required here. That is all that is required. But you guys know from watching my videos, that what were we talking about when we knew, and by the way, the market knew as well, that Janet Yellen was going to issue all these T-bills. It's not like it was a surprise. And what were interest rates doing? Pretty much doing what you would expect. That would be nothing. And that adds to the complexity of the nothing burger, right? But on this channel, we talked about what would most likely happen, even if interest rates did go up slightly, and that would pull liquidity or pull cash out of reverse repo. And the money market funds that had all the reserves in reverse repo, well, they would just simply buy the T-bills because they're getting a better rate of return. And then that would go ahead and supply the banking system with the reserves, or make up for the reserves that are going down in the TGA. So basically, the amount of reserves in the commercial bank system wouldn't change. It's just the only reserves that would change would be from the reverse repo into the TGA. This was, again, common sense stuff. Common sense stuff. So now let's see what has happened to interest rates. Because again, remember the scary thing, what the mainstream media would like you to believe in this article and what Jerome Powell is, oh my gosh, Janet Yellen's going to be dumping so many treasuries onto the system. And therefore, that's more supply. So what should happen to price? Down. What should happen to yield? Up. What actually did happen? Well, here's the 1 month right here. And we can see going back to May of 2023. When did we get the solution or the when did they increase the debt ceiling? I think that was the beginning of June or so. And by the way, the market would have priced in that supply. So ever since Janet Yellen basically came out and said that she was going to issue this $1 trillion over the next 6 weeks or whatever, what did the price do? The price went up, not down. Price went up, not down. In other words, yields went down. Why? Because there's massive demand, massive demand. And even if there wasn't the demand from the market, it would just suck up the reverse repo. So let's see what's happened there. Tough to see with this chart. Let's go back to the 1 year view. And what has happened? We got May 22nd right here. And then reverse repos at 2.2 trillion. In fact, 2.275 trillion. Now where is it? And notice what it's done over the last couple of days. Fallen off a cliff to the point now where it's 1992. So we've gone from it's gone down by almost $100 billion. Where are those reserves mysteriously going? They're going to the TGA, for heaven's sakes. They're going to the TGA. Jeez. So again, this is something we were talking about on the whiteboard. I'm sure we talked about on this channel many, many, many times, that this is what would most likely happen. And sure enough, it's exactly what we see playing out. So should you be concerned about Janet Yellen issuing $1 trillion worth of T-bills? No. In fact, if anything, there was a great argument why that would stabilize the system, because you're giving the market the T-bills that it wants. And how do you know it wants it? Look at the damn yield, for heaven's sakes. It's plummeting, meaning the price is going up, meaning there's a lot more demand than she's even supplying. So, tsunami of U.S. debt is hitting the market. That is very, very true. But should you be concerned? No, absolutely not. Now, there's a lot of things that you should be concerned with. That is for sure. And we talk about them on this channel all the time. But this is not one of them. All right, guys, enjoy the rest of your day. Enjoy your weekend. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.